Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The government has announced a rupees 22,915 crore fund infusion as part of its first tranche of bank recapitalisation for 13 public sector banks with stressed balance sheets. State Bank of India will get the maximum share at 7,575 crore, followed by Punjab National Bank at rupees 2,816 crores and Bank of India at 1,784 crore. Now, the government had last year announced Ethiraj, a revamp plan to pump in 70,000 crore rupees in state-owned banks over the next 4 years. The money is expected to provide liquidity for banks for lending and to help them raise funds from the market. The remaining amount will be linked to performance, the government has said. Now the question is this enough to revitalise India's public sector banks? What more needs to be done, and more importantly, are we at the end of the tunnel? To discuss this, I'm joined by Nitin Kumar, banking analyst at Antique, Murthy Nagarajan, head of fixed income at Quantum Asset Management Company, and Dr. Brinda Jagirdar, former chief economist at the State Bank of India. Thank you all for joining me. Let me begin with you, Nitin, since you're a banking analyst here. First of all, is the scale of the problem out there? Do we know how bad the situation is in the public sector banks and their balance sheets?
I think the scale of capital that is required has come down, because if you look at when this whole episode of Basel III started, you were talking about 2.3 to 2.4 lakh crore of capitalization that is needed for these public sector banks. And this number came down to close to 1.8 lakh crore, which the government itself indicated at the time of Ethiraj. Now, we have done an assessment of the capitalization requirement for the system, focusing more on PSU banks, and we find that the total capital requirement is now 1.25 lakh crores over the next 3 years. So what government is now...
Which is sharply different from
Fitch's decline.
Fitch says 6 lakh crores.
Yes, that is a sharp decline, and that is all due to the change in growth environment. Though the profitability has taken a big knock, asset quality has gone for a toss after this RBI's AQR exercise, but just because of the sharp moderation in growth. Earlier you were projecting them to grow at 18-20%, which then came down to 14-15% at the time of Ethiraj, and now you are talking about 8 to 10% sort of growth for PSU banks over the next 3 years.
So explain that to us. Why does lower growth mean lesser capitalization required?
That is simply because your risk-weighted assets will not grow at that pace as to what was earlier estimated, and because of which lower capital will be required to support that growth. And anyway, banks will have some bit of internal accrual, so we are estimating them to do 8 to 10% sort of ROEs on an average. Some banks will do slightly better, some will do slightly worse.
So you're saying, so therefore at the end of all of this, things are a little better than what they seemed?
On the capitalization front, yes, the amount that will be needed from the government side it definitely has come down.
Right. Okay. Murthy, what's your sense? Again, just to come back to that question for once, have we exposed the state of the balance sheets, or are we fully aware of how bad things are over?
Yeah, the point is that this has been starting from 1990 onwards. We have been recapitalizing this bank for a long period of time. So this again is something which is happening, is that why is it the private sector bank is not having this type of NPAs and why the public sector is having that? There are other things which are involved. So you are just giving them right now, but what about their efficiency, how they are going to lend? So after another 5 years or 6 years, you get one more business cycle like this. Again, you will have a boom burst. So how much time you are going to spend on this, and how much money of the taxpayer money has to be spent here? So given that thing, I think over a period of time, slowly they should see that except for they should either merge all these banks and have one thing. So then interference has to be on the lower side. Given those type of things, I think it's, of course, banks are required, but we have to also see that the private, nowhere in the world you are seeing this type of concentration where 2/3 of the credit is being delivered on the PSU side. There has to be some private sector which has to take up that place, and the RBI and the government should facilitate that.
Okay, right. Brinda, let me come to you. What's your sense? Does this create a false calm? I mean, when the government does step in and helps banks like this to either recapitalize, and therefore with the good intention of bringing them back to a state of being active lenders?
Let me step back a bit, Govind. Let's see why it is important actually to recapitalize the public sector banks. First of all, public sector banks account for about 70% of the total assets of the banking system in the country. So they are very important players. Then look at the profitability. In 2015-16, public sector banks made a loss, while the private sector banks, they could actually show a profit of about 11%. So their profit growth went up by about 11%. Similarly, with capital adequacy, the public sector banks' capital adequacy is about 11% plus now, but RBI expects going forward that in the next year it could actually go down to 10%. So profitability low, and then of course stressed assets. Public sector banks roughly have about 14.5% stressed assets, while the private sector banks and the foreign banks have something like about 4.5%. So there is a huge imbalance. Now, why did this thing happen actually, this kind of imbalance? Because in 2008, after the crisis, the government really wanted the public sector banks to go out and lend. So to keep up the growth momentum in the economy, to give an economic stimulus. So public sector banks lent to infrastructure, industry, and which really didn't materialize the way it was expected to. Though private sector banks did come in and pick up a bit of the slack, yet the gap has not been filled. And if we want growth to pick up again, if we want growth to continue in the economy, then it's very important that the public sector banks start lending again for manufacturing, industry, infrastructure.
Yeah, right. So Nitin, are we, therefore, as Murthy also said, is there a threat of going back into that cycle if public sector banks are finally the only, almost the lender of first resort, forget even last resort when it comes to large projects, infrastructure, roads and so on?
I think it may take some time for the sector, because until the time, as Brinda said, public sector banks are still forming 70% of the system. It will take time for private banks to ramp up. They have come a long way. They're today accounting for almost 28 to 30% of the total assets, which I think will increase to 35 to 37% over the next 3 years. Because over the next 3 years, you are going to have an environment where public sector banks will continue to be starved, not as much starved, but as they will be challenged on the capital front. They'll be grappling to achieve the Basel III targets, which are on a transitionary phase. It will increase year
So you're
every
saying
year.
market forces will take care of some of the problems that we are likely to face. Okay. So what's your sense? If we were to look a little ahead, do you see public sector banks once again coming back to take some sort of support from taxpayers, or?
I see, besides this capitalization that we have calculated at 1 point.
And the reason, let me supplement that quickly. The reason I'm asking this is, have we done enough this time around in terms of transparency to ensure that something like this doesn't happen?
I would think so, because these were what the asset quality cleanup has happened, and they were long evergreen accounts, and I think after this probably the underwriting efforts will improve. Government is taking much more interest in seeing that the lending is done in the right fashion. So this sort of thing should not happen again, but you can never say never, I think, in the lending space. And public sector bank needs to get their act together, because for long, if you look at they have not been able to build up the retail franchise. The focus has been more on the industries, which was for the various reasons that they were the bulk of the credit growth in the Indian system comes from that segment. But going ahead, you look at the retail growth, you look at the private banks doing overall growth of 20% average. So they still need to get their act together and focus on the right avenues for lending.
Okay, right. So Murthy, what's your sense? If we were to assume that we've opened up bank balance sheets, we've got a better handle on their numbers and their stressed assets, do you think that we could in some ways look at a new phase of PSU bank active management as well as performance in the market?
I think it is slightly unlikely, because highly unlikely, because the point is that we are not seeing the dynamism which is required for running a company. Ultimately, most of this they have got 3-year, 5-year type of tenure, so they are all political appointees. Given that type of situation, you are not going to see this thing being changed dramatically. Given that situation, that why is it the same account these people private sector banks are able to recover the money, but the public sector banks aren't able to do that. The same account we have seen historically, we have seen that these people are able to recover the money, they are not able to do.
Okay, so let me understand that from a different point of view. What is the outcome of this? Either assuming these banks, public sector banks, continue the way are, which in most probability they will, and we have a 70% weightage in overall assets. What's the larger economic impact that we should be either worried about or we should be watching?
For us, on the debt market side, it is fiscal deficit on continuously being provided, banks being provided capital and write-offs happening on that particular thing. So you are going to see this, and it's a self-feeding system. They are actually getting money. The fiscal deficit goes up, interest rate goes up. There is pressure. Again, these people banks come and buy government securities. So these are things which are there. The other problem is that it is actually leading to adverse selection. So people like you and me, public sector banks should give you lower rates. They are not able to pass on the lower rates because of this historical stress which these people have got, and they have to recover from us. So that is the interest rates not coming down.
Okay, so Brinda, are you also seeing an outcome similar to what Murthy is talking about? Do you see any silver linings, assuming we are putting things back on track now?
Yes, certainly. It's not just what is coming out of the government's budget, but let's also look at some of the measures which RBI has announced. For example, they've said the revaluation reserves, you could take 55% of that into tier 1 capital, earlier it was tier 2 capital. So that is giving banks a leeway. And Reserve Bank is also encouraging banks to shed their non-core assets to shore up their capital situation. And of course, we are looking at mergers. So all this shows that this public sector banks are really being primed to come back into shape, and we will see them start to lend again once the economy picks up. Because right now credit growth is growing only about say 9-10%, except for of course home loans and personal loans, but credit to industry doesn't seem to be picking up. But we need for credit to grow at about 12 to 15% per annum. And so I think banks are being prepared to do that. And where public sector banks is concerned, I think we need to differentiate, because not all of them can be put into the same basket. There are some who are extremely efficient and some who are really are very top in corporate governance. So we need to really look at the other banks which are weak and bring them back, find some solutions for those banks.
Right. So, Nitin, are you seeing, does the market prices reflect that? Some banks are clearly performing better than the others, or can be bet on for the longer term?
That is clearly happening. Like private banks are gaining market share, which is reflecting in their trading.
Or even within public sector banks?
Within public sector banks also, though there is not a very big difference that you can make out, except for probably State Bank of India and expectations that are there on Bank of Baroda after the management change. So these two banks are trading at a relatively higher multiples. But other banks, PSU banks have become more of a trading play, so expectations will come and then they will not be delivered, and then again the prices will correct. So this sort of phenomena is something that we are repeatedly seeing. So unless we find some stability to earnings, stability to asset quality, it is they are not trading at sort of stable valuation. It moves all over the place.
Right. So finally, let me get a sum up. Murthy, so 23,000 crores now put in. More may come or more may not. Are we at any better place today than we were, let's say, 6 months ago?
Look, the point is that there is a moral hazard, because from the market perspective, everybody feels that the banks are safe because this type of recapitalization also on a continuing basis happens. So what happens if something goes wrong? Like we have seen in Italy that you have got this big problem. So are we going to do that, or are we going to merge these banks or take some route out, make them more participatory, have the shares getting listed? So that will be a better thing rather than just going on giving them money and not getting anything in return.
Right. We've run out of time. Thank you so much for joining me. Thank you, Brinda. We've got to go in for a break as well. Coming up on the other side, we talk about the inflation conundrum. The gap between rural and urban inflation is rising. Stay with us. Welcome back to Policy Watch. India's inflation conundrum continues. Rural India, which represents close to 70% of the country's population, is seeing much higher inflation levels than in urban India. A report from rating agency CRISIL has said that while urban inflation fell from 9 to 5.3% in the last 24 months, rural inflation declined just from 10.1 to 6.2%. Now, moreover, rural core inflation in 2016, the year, has been at 6.7% in rural India compared to 4.8% in urban areas, while food inflation in rural areas has averaged 5.1% compared to 4.5% in urban areas. A report by the State Bank of India has meanwhile said that price increases in onions, tomatoes and vegetables are now following a roughly 2.5-year cycle. So given all this, the question is first, what are the larger concerns on rising rural inflation? What could be the fallout and what needs to be done to better manage prices and inflation? More so, since we seem to know how they move. To discuss this, I'm joined by Soumya Kanti Ghosh, Chief Economist at State Bank of India, Dipankar Mitra, Economist, and Devupam Chaudhary, Chief Economist at Zyphon Research. Thank you all for joining us. Dipankar, let me start with you. Your broad sense on why are we seeing this discrepancy between rural and urban? Has this been there for a long time and are we discovering it today? And if so, if we've known this for a long time, why have we not been able to reduce the gap?
See, we have the data on rural and urban inflation separately only for the new CPI series. And from the history that we have so far is the trend alternates. So sometimes the rural inflation is higher, sometimes the urban inflation is higher. And there is no definitive pattern into this, except that in case of food inflation and sometimes overall inflation, the softening in urban inflation has been much sharper. But beyond that, there is no consistent pattern into it. If we look at the overall data for the CPI series as such, it is just 50 basis point higher for rural inflation on an average for the whole period. So I think it will alternate. But second, if we look at the sources of the discrepancy between the rural and urban, it is not as much as food. But the problem here is that when the food inflation goes up, because the weight of the rural in food. Yeah, rural basket of food is much higher, almost 20% higher than the urban areas. It gives an upward thrust to the overall inflation itself, both rural inflation as well as overall
Right. So
inflation.
what this means is that rising food prices affect rural India more than
they do
India.
the urban area. That is explanation number one.
Right.
Explanation number two is that the energy prices, if we see, for some reason is rising at a faster rate in rural India. And it could be because of the reliance on the more non-conventional sources of
like
energy.
dung cake, firewood,
right,
chips,
those
and
type
so on,
of things.
Whereas
Correct.
fuel prices have gone down, which urban India has benefited from.
Yeah, absolutely. And the third thing is that in the service sector, there is a transformation which is going in terms of the rural salaried class availing more and more better quality private services, whether it is education, health or recreation. So those are costing more for rural India than it is.
So Soumya, you've done this very interesting 20-year study which looks at prices of onions, tomatoes and potatoes, and you've also maybe cereals later, and you've talked about this roughly 2.5-year cycle. So why is it that if we are aware of it, or are we not aware of it, that we are not able to do something to actually arrest this price rise, and that too in such frequent intervals?
No, I think the report which we have done clearly shows that the price cycle is could range from around 2 years to 3 years. For example, 2 years for potato and 2.5 years are roughly for onion, and also for other commodities like tomato. The point which I am trying to make over here is that I think there is some other reasons, extraneous reasons, apart from the fact that it is only because of supply management. Because typically, for example, if you look at the potato and onion prices, now there is a clear pattern that potato prices will if it rises in year Y, onion prices will rise in the next year, or vice versa, and this has been the trend which has been following in the last 5 years. There is no reason to believe that why these patterns follow, because if I understand that the onion and the potato prices depends on several factors, onion prices follow a cowboy pricing model, where the potato prices generally depends on the supply in the market. So my hunch is that there could be some catalyzations or some interest which works behind this price increase and manipulate the prices. Otherwise, I absolutely see no economic reasons why for the last 22 years this cycle has been going on, and it is only restricted to 3 commodities, as we have said in the report: tomato, onion and prices. So my hunch is that some political interests have been playing, there have been some price catalyzation. The farmers have been unable to offload in the market at correct times, and every year we see that this price increase continues. So until and unless we are unable to do something about, not only about the fact that the agricultural sector needs to be revitalized, and also to break this monopoly of pricing power of a select group of what I will say are traders, I think it will be very difficult to break out of this vicious cycle.
Okay, Devapam, what's your sense? If we were to now look at solutions, I mean, so the CRISIL report has some solutions. Soumya talks about, let's say, looking at the problem in a slightly larger context than maybe just the, the supply side, on the agriculture supply side. What could be?
So this SBI report does sound interesting, and if I go back to the rural debate as to why is the gap between rural and urban inflation, as Dipankar was saying, the data time series is very short, but whatever little time series we have, in that, if you look at data from 2014-2016, rural inflation has increased 75% of the times, while urban inflation has increased only about 55 to 60% of the time. So that tells you the story in its entirety. Now, a major reason, as you rightly said when Dipankar was saying, talking, is the concept of energy. Concept of energy in rural India and concept of energy in urban India is very different. Urban India energy prices are impacted by global prices, and hence we are seeing a decline. Another major impact is transportation and other services. Now, because of this drought-like situation in rural India over the last 2.5 years, investment in rural India has slowed down very significantly, be it private as well as public. So, I would go to the extent.
So, are you saying even infrastructure?
Yes, absolutely. So, I would go to the extent of saying that our 5-year plans since independence so far has not done that significant a job in urban rural India as they have done in urban regions in augmenting the infrastructure that rural folks have. Right. So if you look at bus travel, if you look at roads, the road networks, etc.,
there has been no significant change compared to 1970s and 2000s. As a result of which there definitely has not been any steep decline in transportation prices. In fact, there has been rising because whatever little infrastructure has been existing from prehistoric times is still there, and hence demand is not matching supply. Supply is very less compared to demand, so prices are going up.
So right, so the solution therefore is, I mean, there are obviously some very long-term solutions here, and for instance, the CRISIL report says that one of the things that can be fixed is on the fuel side by expediting the cooking gas connectivity to 50 million consumers, which was talked about in the budget as well. So are we looking at those kind of solutions? Are they short-term, long-term? Because this is, I'm assuming, long-term worrying when you have rural inflation rising faster than urban.
Yep, so that the long-term solutions are definitely there, but then there has to be some bold steps taken by today's government in order to have some short-term measures also. If you have recently followed the APMC, entire APMC issue that the Maharashtra government had started and the ensuing strikes, etc. Now that issue, the way we read it on the media is saying that it's targeting middlemen so that urban prices remains in check. Because the rural agriculture are getting a very little price where the urban people are paying a lot. The same thing applies in the reverse direction also, because many of our food products are imported, and by the time it reaches the rural folks from our ports, which are mostly in urban regions, the prices are extrapolated very significantly. So this middleman thing of concept needs to be driven out from both directions for food products or products coming from rural to urban.
And that's an interesting point that we focus mostly on the urban supply chain.
These are bold steps which the government needs to take.
Right. So Dipankar, what's the short-term to medium-term response to this?
Yeah, I think both short-term and long-term measures are required, but we have to acknowledge one fact that we have managed the recent food inflation, overall food inflation, quite well. I mean, for 2 consecutive droughts and weather disturbances that we had in various parts, we are still managed to have the inflation within the 5 to 6% rate, which is a significant achievement, and it has happened because
so it's an achievement of monetary policy or supply side?
No, it's a achievement of the government side, proactive measures on inflation when they had assumed office and subsequently, and that includes keeping the MSP within reasonable limits. Going forward, we will have to learn from the experience that why intervention in certain areas like pulses did not actually result in the kind of outcome we had thought, and it could be the center state coordination, it could be we have to look into the micro issues of why the ships were not unloaded in time, etc., etc. So and also the fact that we wanted to take pulses as part of the PDS system, the progress regarding that, all these things we need to check.
Right.
So these are very short term measures only to deal with sporadic increase in the certain prices, but the long term measures of supply chain, etc., are also very significant from the point of expectation management. If you take a long term management and long term measure, the benefit of it in the short term is in curbing the expectations which remain unhinged till you take those measures.
Right. Okay. Soumya, what's your sense if you were to look ahead? You talked about this 2.5 to 3 year price cycle. Are there things that we could be looking at or doing to try and correct that imbalance?
See, I think just want to add one thing to the rural part. If you in rural areas, the core inflation, if you look at the housing part, is not there. So that is also another thing which also keeps the rural prices elevated, in the sense that the problem with the rural is that the core part also in the rural areas is sometimes higher. For example, like items like clothing, footwear, which basically reflects the aspirational needs of the rural population. So I think we cannot do much over there in terms of the aspiration class. As far as the steps which you want, I think if you ask me the steps which has to be done, I think the first thing which we need to do is that the free movement of commodities across states. So every year you see that either the potato prices crashes or onion prices crashes, the first thing. The second thing is that I think even in the food prices measures also, even if I look into the urban prices, for example, today we have also done a study by looking into the price margins across the state. For example, in Mumbai only, if you go to an area like Vasi, and if you are saying Dadar or Santa Cruz, or even in Kolaba, the price margins could be 4 or 5 times higher. So I think that what the government needs to do is to very strictly monitor the prices even at the retail level, at the margins by setting up more amount of fair price shops. And there are also successful experiment also. For example, in Gujarat there has been examples like Krishi Mahotsav, which has happened on a regular basis. So there has to be a more farmer and consumer interaction that could be planned by the government in whatever ways. Basically the farmers could come and offload the items on say on a weekdays in one of the local markets. So that is one way of looking at the thing. The other way is to strengthen the distribution system and the infrastructure so that the commodities reach the places at the right place at the right time.
Right, Soumya, thanks for that. Devupam, before we go, what's your index? You've got a proprietary index which measures consumer expectations. What's it saying right now?
So the consumer expectations we have has shown some amount of growth over the last 2 months. It has it had in fact fallen off a cliff from between December till March. It has started to again rise up. So that's a very good sign. But we also track inflation on a weekly basis using a scaled down proxy of what the government basket is, and we do it in rural and urban both. The interesting part is while the urban weekly index, inflation index, which is actual prices in the mandis, has been slowing down over the past 3-4 months now, the rural inflation has been showing some very interesting trends. So what we have observed is for the first 2 weeks or 3 weeks of every month, there is some sort of a slowdown in rural inflation, very marginal, but then there is a steep pickup in the last month. So that causes the overall rise in inflation, and there has to be some monthly seasonality associated with it.
Right. We've run out of time completely. Thank you so much. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.